in the real world, gold is necessary even, right? I mean, like, and I think the Chinese central bank is realizing that it's necessary. It's no one else's liability. It can't be hacked. It's in a vault in Beijing or wherever it is, wherever they hold it. And same thing with Russia. It's in a vault in Moscow. So they do have a lot of gold too. They're also buying from internal sources. So, Russia produced gold. So like it's necessary. It's not even a good thing. It's necessary to have in this world. And I think there's a reason why Chinese consumers are buying gold and not Bitcoin. And I think that that's because they also like the idea of having it, holding it, right?
Hi, and welcome to Wealthion. I'm James Conner. And before I introduce you to our guest, just a quick reminder of Wealthion's upcoming virtual conference in conjunction with SALT, and it goes live on June the 1st. We have some amazing speakers, including Raoul Paul, Lynn Alden, Rick Rule, and many more, all of which will help you navigate the financial markets during these very uncertain times. Once again, that's June the 1st, and you can get more details on our website, wealthion.com. And now I want to introduce you to Chris Mancini. Chris is an associate portfolio manager of the Gabelli Gold Fund, and Gabelli is a bottoms-up value fund based in New York with over $30 billion in assets. Chris is focused on the gold sector, and we're going to get his views on gold and also gold equities. Chris, thank you very much for joining us today. How are things in New York?
Jimmy, things are beautiful. One of the nicest days of the year, I think, so far. Beautiful sunny day, finally. Nice, not too humid, so I'll take it. Let's lock this in for another 3 months. I'll take it.
And the gold and silver price are going in the right direction, so we have a lot to be thankful for.
Yeah, exactly. So we'll see. So gold is doing well, silver's doing well. So yeah, I mean that's also good too. That makes for a nice New York late spring day also.
So one of the things we try to do at Wealthion is provide investors with insights on how to grow and protect their wealth. And you and your team believe gold is one way of doing that. And I want to begin our discussion right here. Why should investors allocate capital toward gold and gold equities? What are the benefits of doing so?
Well, the benefits of doing so really, big picture, it's a diversifier. So there are lots of circumstances in which you might see the stock market go up. You might see the stock market go down and gold go up. That's really why you want to have the gold. And I mean, that could happen in a scenario in which, say, right now, if we have like sticky inflation and the economy starts to pull back a little bit. So in that kind of stagflationary environment where you'd see profits get squeezed for companies and the stock market would likely decline in that scenario, the price of gold would probably go up because it would be seen as a store of value. And again, even in this scenario, even more so a store of value because the stock market's going down. So you want to have it as a diversifier, as a non-correlated asset. It makes sense for everybody to have a little bit in their portfolios at least.
And I know you're not an economist, but you just mentioned stagflation, and I'm sure your firm has a view on stagflation. Is this a possibility?
Yeah, I mean, I think it's a real possibility, like you said, not an economist and not really the firm's view, but I think that the possibility is for sure there. I mean, we're seeing these persistently sticky prices. It's kind of been built into the psyche down here in the U.S. that prices will stay high for a while, and that we're kind of used to prices going up. And then we're also seeing a slowdown. We're seeing the consumers being pinched. Number one, I mean, the higher prices do cause consumers to pull back a little bit. And number two, this big, huge rise in interest rates from essentially 0% to 5.5% in around 2 years is causing consumers to take a little bit of a step back. We're seeing it in the housing market. We're seeing it in autos, and I think it'll trickle down through to the whole economy. So I think there is a real possibility that we'll see a stagflationary environment.
So gold has caught a bid in the past year. It's up over 20% on the year. And one of the reasons why is because of central bank buying. In both 2022 and 2023, central banks acquired approximately 25% of global production. And why have central banks been such aggressive buyers of gold?
Yeah, central banks have been buying because primarily the Chinese central bank is the biggest buyer. And the reason that they're buying is because they saw what happened to Russia. When Russia invaded Ukraine, the United States and European countries essentially confiscated Russia's dollar and euro denominated reserves. So around $500 billion of total reserves were essentially taken from Russia. And the way that the US and the European countries were able to do that was through saying that we weren't going to pay Russia back. So Russia owned U.S. Treasuries, and essentially, or not essentially, in actuality, had lent the U.S. government money. And so what we said to Russia was, okay, look, you invaded Ukraine. We don't like this. We are not going to pay you back on that money that you lent us. So China saw that happen and for lack of a better term, I think, started to freak out and went, wait a second, we have $1 trillion of treasuries. There's a distinct possibility here that if we do something in Taiwan or, if we do something that the U.S. doesn't like, they could say, we're not going to pay you back. And so China's diversifying out of dollars and into gold. And that's also trickling through the rest of the world central banks that hold dollar-based reserves. They're saying, look, it could happen, right? Like if we own treasuries, it's a liability of someone else, right? So we need to watch out for that. So other central banks are also diversifying out of dollars and into gold.
So that's what central bankers are doing. Now, you and your team, you speak to investors, both large and small, institutional investors, pension funds, et cetera. What are they doing?
I mean, it doesn't seem like they have any interest, frankly, in gold. I think that in the U.S. specifically, we're seeing this real tech boom, this AI boom. And, I think although the pension funds like to say that they're very diversified and that they're looking for non-correlated assets and things like that, I think that, they also tend to follow trends. And the trends right now are in tech and stocks generally, and private equity. That's obviously a big trend, and that's done very well. So we're not seeing any interest right now for gold or gold mining equities, which is what we do more specifically.
So gold's done relatively well this year. It's up over 20%, trading somewhere between $2,300 to $2,400. What's your view on the longer term target price? Do you think it's still has more room to go on the upside?
I think that the really interesting thing about gold is that it's done so well this year, notwithstanding the fact that there have been big withdrawals or redemptions from gold-backed ETFs. So the GLD is the biggest physical gold-backed ETF in the U.S., and that's seen enormous redemptions this year. And that's a source of supply into the market. So we've seen this big source of supply into the market, and the price of gold has still gone up. So I think that if and when we do see that trend turn and the gold-backed ETF starting to add gold, I think the gold will definitely have another leg up. And what could cause that to happen might be, again, a view that there's going to be the stagflationary environment in the U.S. But yeah, I think that if and when that happens, gold could definitely go to the from 2,400 up to 2,700, 2,800, something like that for sure.
I want to get your views on silver now. It's finally above $30 an ounce, touch wood, and it's up over 30% on the year. What are your thoughts on silver, and do you think it keeps going?
I think silver's the poor man's gold, really, at the end of the day. So when we do see this, like gold have a run, silver tends to have beta to the gold price. So silver tends to catch up to gold on the upside. And I think that happens so gold tends to move first, then silver tends to catch up. And I think the reason that happens is because silver does have a very big retail following, I think, within the US. So I think that, people really see that they could buy, 1 ounce of gold for $2,400, or they could get at this point, forget the exact ratio now, but something like 85, 1 ounce silver coins. And it feels nicer to hold 85 ounces than to hold 1 ounce for $2,400, which is a substantial amount of money. So I think what happens is there is this demand for silver from retail as the price of gold goes up. And I think that if the price of gold keeps going, I think silver will do better than gold.
And so we have gold trading at or near all-time highs, but silver is nowhere near it. I think $50 is the all-time high. And if you were to adjust that for inflation, it would be significantly higher. But do you think we take out $50 here in the next year or 2 years?
I mean, that's a big move, from 30 to 50 is a huge move. I mean, I don't know if we'll do that. I mean, I remember when it was at 50 and that was, there's a lot of speculative hype around that at the time. That was when, like you said, and there was also a lot of speculative hype around gold at the time. I think that, if gold goes to 3,000, like above 3,000, then I think that we could see silver touching like a 45 range. Definitely.
And so why do you think silver is underperforming? Why isn't it trading closer to its all-time high?
I think the issue is that what's driving the gold price is this demand from central banks, like the Chinese central banks and other central banks around the world. There's Eastern demand for gold. Whereas I think that in the U.S., you'll start to see demand for silver if the gold price from retail, if the gold price really goes. In the East, in China, Korea, there isn't that same affinity for silver that we have here. It's really gold. So they'll buy a very small little like bean, of gold rather than buy 1 ounce of silver. So I think that what we have to do is and we've seen that there's really no interest for gold in the U.S., very little. So I think that in order for silver to really have its run, we're going to have to first see the gold and the ETFs start to go back up. So we're going to have to see again, like the price of gold have another move here from 2,400 up to say 2,600, something like this, before we see silver really make its move, and that'll be predicated on retail demand in the U.S.
One of the unique issues associated with silver is that 75% of all silver comes or is produced as a byproduct. Okay, so copper producers, for example, are very large producers of silver. Do you think this also comes into play? And I guess when I ask that, what I mean is if you have copper trading at or around $5 a pound, and you have somebody like Codelco, the world's largest copper producer, and they're just pumping out as much copper as they can, well, they're also producing a lot of silver, and they're just dumping it onto the open market. Do you think this comes into play?
Yeah, I mean, it would, but I think that kind of what's attractive about that analysis or that dynamic that you just mentioned is that whereas you can see a supply response to a higher gold price, so the gold price goes up and then miners say, okay, look, gold miners say, look, we're going to get some more gold from this area here that we couldn't get before because it wasn't economic. You could see a pretty quick, not very quick, but you can see a somewhat kind of time-oriented supply response to an increase in the price of gold. You don't really see that for silver. If the price of silver goes up a lot, if it goes to 45, and the price of copper stays at $4.75 a pound, you don't see that supply response on a silver perspective because the copper miner is going to keep on pumping out the same amount. So that's what makes the silver dynamic a little bit more attractive, I think, even on the upside for silver. Now, that being said, yeah, in this higher copper price environment, to the degree that the copper miners are now doing the same thing that I said the gold miners would do, it is a little bit of a headwind for the silver price.
So I want to talk about valuations now and equities. Mining, as we both know, is an extremely complex business. There's so much to consider when we talk about metallurgy, grade, size, geopolitics, and so many elements which impact a company's profitability. And when you look at some of these large producers, Newmont, for example, the world's largest gold producer, it's up 2% on the year. Barrick, the second largest producer, is down 2%. Agnico, the world's third largest producer, it's up over 20%. And we already mentioned about gold, it's actually up over 20% on the year. But why are we seeing this large divergence between the gold price and equities?
That's a good question. I mean, well, the big picture is that in something like, well, why the equities by and large haven't performed well, and why say Agnico has outperformed, is because there's been a big increase in the cost of production. So during COVID, it was very difficult, as we all know, but it was impossible, obviously, to work from home for a mining company. Mining companies had a lot of other restrictions placed on them. It just became very, very difficult and very cost intensive to mine for gold around the world. And so as the price of gold went up, the cost also went up. So the margins didn't expand as they should have, and or as they would have otherwise if the cost hadn't gone up. So that's why the stocks haven't done as well. And I think that one thing that from an Agnico perspective, they're lower cost, and because they're primarily in the Abitibi, where they have a work base that's like very friendly, where they have a very good working relationship with their labor force, and they've treated their labor force very well over time. They haven't seen the big cost inflation that some of the other mining companies have seen. So that's why Agnico has really outperformed those other two, Barrick and Newmont, that you just mentioned.
And there's also the geopolitical element, as you mentioned. Agnico, they own two of the largest gold mines in Canada, and so a large percentage of their production comes out of Canada, which is very safe, and the rule of law is always upheld. Whereas Barrick is more focused on, I guess, what you could say, more challenging jurisdictions. Is that a big factor?
Yeah, definitely. So, I mean, when you look at the other thing is, so there is very little interest, as we mentioned, in gold generally, and even less interest in the gold mining stocks. So to the degree that you are a big fund manager in the U.S. managing billions and billions of dollars in some big mutual fund, and you want a go-to name, right? So you'll go and you'll ask somebody, you say, talk to a broker and say, okay, which stock should I own? And Barrick and Newmont both have some hair on them, and Agnico really doesn't. And the hair on the Barrick story is, to a large degree, their exposure in Africa. And Mali specifically is talking about restructuring their mining code. So Barrick has a very big mine in Mali. And then you see, and they also have a big mine in the Democratic Republic of the Congo, and that actually has political issues all the time, so we know that. And then you look at something like Newmont. The hair on their story, they're in good political jurisdictions. The hair on their story really is that they just completed a merger with Newcrest, and the market doesn't believe the story right now. It doesn't seem, or thinks that they did it for maybe the wrong reasons and not the right reasons. And so the market's still waiting to see how that plays out. But for Agnico, there really isn't much hair. I mean, like you said, great jurisdictions, 85% of the production from Canada. The other 15% is from really three mines, say around 5% each in Finland, Australia, and Mexico. So those are also great jurisdictions. Low cost producer, pays a dividend, created value for shareholders over time. So that's the go-to name, and that's why it's outperformed so much relative to the other two.
And when you look at these large producers like Newmont, Barrick, and Agnico, what gold price do you think they're factoring in? Because there's no way it's $2,400 or $2,000 or even $2,000.
No, definitely not. I mean, when they mine their deposits, they're factoring in more like a $1,400 gold price in terms of where they calculate their reserves. So, and that's how they get this big margin now, right? Because notwithstanding the fact that the cost to mine has gone up, the average cost of production in the industry is right now, say maybe $1,350 an ounce. And so there is right now on average over $1,000 per ounce margin. So yeah, I mean, if the price of gold goes up and the companies and the market gets comfortable with the companies taking a little bit of a lower margin and mining some gold on the periphery of their deposits, say, then there is a lot of upside to the valuation of these companies in terms of extending the mine lives.
But I guess the question I meant to ask was, what price are the gold equities factoring in?
Sorry. Okay, sorry. The gold equities. Yeah, I mean, I think that the gold equities are factoring in more like more like $2,000 an ounce than $2,400 an ounce. And the market just doesn't believe that this price is going to be sustained and maintained. So I do think that if the price stays here, and the gold price stays here, and the companies start generating this free cash flow over the next few quarters, and the market starts to see that, I think that the gold miners do have a good 15 to 20% up from here.
So that's an interesting point that you just made, because we mentioned earlier about how the central banks have been very aggressive buyers, and that's one of the reasons why gold's done so well in the last 2 years. But do you think, because of the central bank buying, do you think they are artificially keeping the prices high? And if they weren't buying, would the price be a lot lower? Maybe at $2,000, maybe $1,800.
Well, I mean, yeah, I think so. I mean, I think that they are, like, I think the central banks are, or have been, I don't know what they're doing in the market now, because China's gold purchases have declined as the price has risen. So they're not buying as much per month as they were when the price was lower. So something else might be sustaining it up here. But yeah, I mean, over the past year and a half, China and other central banks have been like a significant, like you said, around 25% base load demand. If that were gone, yeah, then it would be, deleterious to the market price.
And Chris, we can't have a discussion on gold without talking about Bitcoin, which is sometimes called digital gold or new gold. And as you know, the SEC approved some Bitcoin ETFs earlier this year. They recently approved Ether ETF. Do you think money is being diverted away from gold into Bitcoin? And do you think a lot of the investors that used to invest in gold are now investing in Bitcoin?
I don't really think so. I mean, I think that the most rational response would be, like it has to be to some extent, but I just don't get that feeling. Like, one example that I have to get, I really haven't told anybody this, but it's funny. My 13-year-old son has a game on his phone where he's poking at, like, the names of, like, instead of Mercedes-Benz, they call it Mercedes-Benz or something like that. And instead of Google, they call it Goggle. But all he does is he looks at the chart and he goes, do I think the price of this stock, quote unquote, is going up or down? And, like, I go on the train back and forth to New York City and I see people doing a similar thing, like actually on their phone betting on stock prices and things like that, and these meme stocks and whatever. So I don't think it's the same buyer. I think Bitcoin also has people, like, doing similar. It's driven. I do think now Bitcoin lovers are going to really get mad at me, but I do think a lot of it is driven by this, like, this momentum kind of day trading on the apps and stuff. Now, could gold get that kind of bid at some point? Well, I sure hope so. And could that be manifested and maybe flows into the ETF or something like that? I hope. But I mean, do I think that it's taking away a lot of interest? I think it is on the margin, but I don't think it's taking away a lot of interest from gold. I mean, it's a different buyer. It's like central banks, like you're saying. I mean, hopefully pension funds. It's big funds. It's not really that retail buyer.
I recently had lunch with a portfolio manager in Toronto, and he made mention of the fact that he's really concerned about the younger generation and their inability to invest. The younger generation doesn't invest anymore. They're traders, and that might mean day trading equities, meme stocks, or short-dated options, or sports betting. It's all really the same sort of thing.
Yeah, no, I mean, it is like, I mean, now I was very tired last night. This was like 11 o'clock. And my 13-year-old said, "Hey, Dad, can you help me figure this out? Is this stock going to go up or down?" And what I want to do is sit and say, look, it's more important to look at stocks or valuations, their cash flows going forward and whatever. And that's the conversation I'm going to have with him. But unfortunately, I said, you know what, I don't know, I'm going to sleep. But I think that yeah, it's definitely a concern, and I laugh about it. But it is definitely a concern that the younger generation is very focused on just charts and where the stock might be going based on what the next social media hashtag is or whatever.
So when you look at the performance of Bitcoin, it's up over 60% this year. It was up 160% last year. And then you look at gold and, it's doing okay, but We're not seeing those types of returns. But do you think, like, how does gold compete with Bitcoin in the coming years? And do you think gold is a dying asset class?
Oh, I mean, I think that the big picture is that, like, in the real world, gold is necessary, even, right? I mean, like, and I think the Chinese central bank is realizing that it's necessary. It's no one else's liability. It can't be hacked. It's in a vault in Beijing or wherever it is, wherever they hold it. And same thing with Russia. It's in a vault in Moscow. So they do have a lot of gold too. They're also buying from internal sources. So, Russia produced gold. So like it's necessary. It's not even a good thing. It's necessary to have in this world. And I think there's a reason why Chinese consumers are buying gold and not Bitcoin. And I think that that's because they also like the idea of having it, holding it, right? If the Chinese government can't do anything well, could they? Sure, but it'd be a lot easier, I think, for the Chinese government to take the Chinese citizens' Bitcoin than to take a Chinese citizen's, gold bar that he has under his floorboard somewhere. So, so I think, no, it's not a dying asset class. And we're seeing more and more that it's becoming more of a necessary asset class. But Americans haven't woken up to that yet. And America really, frankly, is where, in a hyperbolic way, America's where all the money is. We know that. But Americans haven't woken up to that necessity yet. But I really think it's only a matter of time.
So something else that really stands out to me when it comes to Bitcoin is that there's a lot of champions behind it, a lot of well-known investors, and Larry Fink, Paul Tudor Jones, Michael Saylor, and I believe even Stanley Druckenmiller have all gotten behind Bitcoin. And we really don't see that with gold.
Yeah.
Why do you think that is?
I mean, it's the new hot trend. I mean, right? Like these guys are all they want to stay on the cutting edge, right? They want to be seen as relevant. I mean, Larry Fink is trying to grow a business. He's in a very growth-oriented business, right? So you don't really grow by talking about something old. You grow by talking about new things. I mean, he was the one who really, I think, championed the whole ETF cause. And I mean, he's whatever, laughing all the way to the bank, right? He'll be a lot, what he makes in 20 minutes might be more than I'll ever see in my life. So I'm not knocking the guy, but it's understandable that's how they're structured. You know what I mean? And that's kind of why they'd be pushing something new and hot and sexy per se, and not something old and stodgy like gold. But again, I think that we're slowly but surely like waking up, and when the market does wake up to it, when we do see that there's a necessity to have it, I wouldn't be surprised if they start to get behind it too.
Yeah, that will be interesting to see if that does happen. So we don't really have any big champions pounding the table on it. But one thing I want to get your thoughts on is the fact that Costco, one of the largest retailers in the U.S., 72 million paid members, they started selling gold in Q4 of 2023. And now they're selling, I believe it's $200 million worth of gold every month. And they can't even keep it in stock. It's going so fast. But what are your thoughts on this? And what does this tell you about the general public who is going to Costco and buying 1 or 2 ounces?
The average person the average person anywhere likes to hold things, likes security, likes the idea of having something of value that they can hold, and they know it'll have value. And that's what's being reflected. People trust Costco. They trust the brand. They know that what they're getting is actual gold. And so now, it's never really been available like that in the U.S. before on a retail basis. To get gold before Costco, you've had to go to you have to either go online to some website you've never heard of, or there's really no other place to do, there's no other way to do it. I mean, you'd have to go, like in New York City, you could do it, but you go to we have the Diamond District on 47th Street. And you have to walk down walk into these back out, and I've done it actually. You walk into this little booth, looks like a back alley place from the 1930s. And, you talk to somebody that, you've never met before, and this and that, and you get references. And it's hard. The point is, it's always been hard to do. Now that Costco's made it easy and people trust Costco, it just reflects the fact that people like to hold things of value in their hands, and it shows the intrinsic value. And again, it's just the necessity of having gold.
Yeah, no, that's a very good point. You got to make it easy, because even when I buy gold through one of the Canadian banks, it's a very onerous process. And then when you go to sell it, it's still very complicated.
Yeah, exactly. So just making it easy, and Costco's, they've linked into that. I mean, they've hooked on to that concept that, look, wow, people actually like this, and they made it easy. And again, they're trusted, which is extremely important.
Well, that was a great discussion, Chris, and I want to thank you for making time for us today. If someone would like to learn more about you and get your thoughts on gold, or learn more about the Gabelli Funds, where can they go?
You can go to Gabelli.com. You can call 1-800-GABELLI. And I'd also like to point out that I just did an interview with Sean Boyd. We were talking about Agnico and how great of a company it is. It's the biggest holding in the gold fund. And so on Gabelli TV, if you go to YouTube and type in Gabelli TV, Sean Boyd, you'll find the interview that I did with him, and it lays out what we look for in a good gold mining company, and also what it takes to build a good gold mining company. And Sean has been really integral in doing that over time.
Well, I will be sure to check that out. Once again, Chris, thank you.
Okay. Thanks, Jimmy. Thanks a lot. Appreciate it.
Well, I hope you enjoyed that discussion with Chris Mancini, and it gave you some insights on what's happening within precious metals. We're going to have an even deeper discussion on precious metals and many other asset classes at Wealthion's upcoming virtual conference in conjunction with SALT, and it goes live on June the 1st. We have some amazing speakers, including Raoul Paul, Lynn Alden, Rick Rule, and many more, all of which will help you navigate these financial markets during these very uncertain times. Once again, that's June the 1st, and you can get more details on our website, wealthion.com. Thank you again for being with us today, and I look forward to seeing you again soon.